Wall Street made $47 billion in fees last year, selling complicated products to ordinary people who just wanted to grow their wealth. The secret they do not want you to know? 3 index funds. That is it. 3. Welcome to Money Straight Talk. I'm going to show you exactly which 3 funds to buy, how much to put in each one, and why this dead simple setup has beaten roughly 92% of actively managed funds over the last 15 years. If you have been paralyzed by the complexity of investing, today that paralysis ends. Let us start with the most important concept you need to understand before you buy a single share of anything. Most people lose money in the market not because they pick bad stocks, but because they try to pick stocks at study after study shows that professional fund managers, people with Bloomberg terminals and Ivy League degrees and 80-hour work weeks, fail to beat a simple market index over any 10-year period about 85 to 90% of the time. That is not a typo. The pros lose. And when they lose, they still charge you a fee. The average actively managed mutual fund charges around 0.6 to 1% annually. That sounds small, but on a 100,000 portfolio over 30 years, the difference between paying 1% in fees versus 0.03% is roughly $200,000 in lost wealth. $200,000 gone, not to bad markets, to fees. The 3-fund portfolio solves this by keeping your costs so low they are almost invisible. Now let us talk about the first fund. You need a total U.S. stock market index fund. This single fund gives you ownership in over 3,500 American companies simultaneously. We are talking Apple, Microsoft, small manufacturing companies in Ohio, mid-size biotech firms in Texas, all of it. One purchase. The Vanguard Total Stock Market ETF, ticker VTI, or its equivalent at Fidelity called FZROX, charge somewhere between 0 and 0.03% annually, essentially free. Historically, the U.S. total market has returned approximately 10% annually before inflation over the last century. You are not betting on one company. You are betting that American business, as a whole, continues to function. That is a bet most people can get comfortable with. This fund will likely make up 60% of your entire portfolio. It is your engine. The second fund covers international stocks, and this is the one most beginners skip. Big mistake. The US represents roughly 60% of global market capitalization, which sounds dominant until you realize that means 40% of the world's wealth creation is happening somewhere else. Countries like Japan, Germany, India, South Korea, the United Kingdom. When you skip international exposure, you are making a concentrated bet that the US will always outperform the entire rest of the world for the rest of your investing life. History says that is unlikely. In fact, from 2000 to 2010, international developed markets outperformed US stocks significantly. The Vanguard Total International Stock ETF, ticker VXUS, gives you exposure to over 7,500 companies across more than 40 countries for about 0.07% annually. This fund should represent around 30% of your portfolio. It balances your engine with a global safety net. Your third fund is bonds. And before you tune out because bonds sound boring, stay with me for 1 minute. Bonds are not there to make you rich. They are there to keep you from doing something stupid when the market crashes. And the market will crash. It dropped 34% in 33 days in March 2020. It fell 57% during the 2008 financial crisis. The average investor, not protected by bonds, panics and sells at exactly the wrong time. Research from Dalbar shows that while the S&P 500 has averaged around 10% annually over the last 30 years, the average investor only captured about 6% of that because they kept buying high and selling low out of fear. A bond allocation, even 10%, cushions your portfolio enough that you can sleep at night and stay invested. Vanguard's Total Bond Market ETF, ticker BND, costs 0.03% annually. It is boring. It is essential. Now let us put this all together with real numbers. The classic beginner allocation is 60% US stocks, 30% international stocks, and 10% bonds. If you are 25 years old and just starting out, some advisors suggest bumping the bonds down to 5% and increasing stocks because you have time on your side. If you are 38 and starting to think about real wealth preservation, keeping 10 to 15% in bonds makes more sense. Here is what this looks like in practice. You open a brokerage account, a Roth IRA if you qualify because that money grows completely tax-free, and you invest your first $500. You put $300 into VTI, $150 into VXS, and $50 into BND. Every month you add whatever you can. You automate it so you never have to think about it. You do not check the account every day. You do not move things around when the news gets scary. You just keep adding, keep holding, and let compound interest do the work that no human can do better. Someone who invested $500 a month into this exact portfolio starting in 2010 would have approximately $380,000 today without picking a single stock, without watching CNBC, without paying a financial advisor 1% of their portfolio every year. Let us talk about the one thing that will make or break this strategy. Rebalancing. Once a year, maybe twice, you look at your percentages and bring them back in line. If US stocks had a great year and now represent 70% of your portfolio instead of 60%, you sell a little and buy more international or bonds to get back to your target. That is it. You are not predicting the future. You are just maintaining discipline. This is actually a powerful wealth-building mechanism in disguise because rebalancing forces you to systematically sell what went up and buy what went down, which is exactly what successful investors do and what emotional investors never manage to do. Set a calendar reminder. Once a year, 20 minutes of work, done. One more thing before we wrap this up. The account type matters as much as the funds you choose. If your employer offers a 401k with a match, start there. That match is an immediate 50 to 100% return on your money before the market does anything. Take every dollar of it. Then open a Roth IRA if you are under the income limit, which is around $146,000 for single filers in 2024. Max that out at $7,000 a year. Only after both of those are handled should you open a regular taxable brokerage account. The three funds work in all three account types. The tax advantages of the first two just make them work even better. This is the strategy that John Bogle, the founder of Vanguard and one of the greatest financial minds of the 20th century, built his entire legacy on. Low cost, diversified, consistent, no guessing, no trading, no drama. It works precisely because it is boring, because boredom is the enemy of the financial industry and the best friend of long-term investors. If this was useful, and you know someone who has been putting off investing because it all seems too complicated, share this with them today. Seriously, one conversation like this can change someone's entire financial trajectory. Follow us for more content like this every week. No fluff, no hype, just the straightforward money talk that most people never get access to. Now, if you want to take the first step and actually open that brokerage account, M1 Finance is one of the easiest platforms to set up a 3-fund portfolio with automatic rebalancing built right in. There is a link to get started in the description below. 0 trading commissions, automated investing, clean interface. It is the kind of tool that makes doing the right thing the easy thing. And next time, we are talking about the exact moment you should stop paying off debt and start investing instead. The answer is not what most people think, and getting it wrong costs you tens of thousands of dollars. You do not want to miss that one.